业所导致。
Okay, good evening, everybody. Can you all hear me? If you can hear me, please type yes.
很累，做他的长辈，什么累啊？
Okay, good. Okay. Yes, but soft. Okay, let me check.
Region X，看你有没有 energy。很凶，应该。Felix。
Okay, good evening. I think we'll just start. Okay. I have mute all your mics. Please refrain from turning on your mic. Okay. Okay, we shall not wait for any latecomer. We will just start straight away at 7:30 today. Okay. Mhm. Okay, thank you everyone for coming for this unit trust webinar. Okay, this is a standard disclaimer. Okay, so whatever I share is just for information only. Okay, it doesn't constitute any financial advice. Okay, do go and think through before you want to take any action on your investment. A small request: avoid taking any video, photograph during this webinar. Okay. For those that have seen me for the first time, maybe I just do a short introduction about myself. Okay, I'm Darren Chu here. I'm worked 10 years as an engineer and made a career switch to this industry at 14 years ago. That's 0506. Okay, that's before the global financial crisis. After that, I do I quit the industry and come to this services industry. In 2012, I joined Philips Securities, and at 2016, my team actually opened the first Philips Franchise Investor Center at Jurong East, which is called the Philips Investor Center, where I think majority of you are our client from the center. This is the only center that opened from Monday to Sunday. Okay, during at the point of time. Currently, during the COVID-19, our center is closed, but I think from 2nd June onwards, we were able to reopen again. Okay, we have grown our size to close to 20 of us after these few years. Okay, that for those that actually interested to explore this career, or you have any of your children graduating this year, I want to explore this career, can look for me. Okay, we can discuss further, because now there's a lot of new rules and there's a lot of grant given that for those that want to join this industry. Okay, okay, so if interested, can just contact me or contact our team phone directly. What we do best is we conduct at financial education seminars to educate the retail investor, how can they invest better. We have a Facebook page. Okay, do like our Facebook page, and we also have our YouTube channel, which is very unique for our team in Philips Security. I think we are the only team for the YouTube channel itself. Okay, based on my knowledge, do go and subscribe to our YouTube channel, and we are constantly try to upload at least one new video every week. Like today, I think my team member Andy had talked about bank stocks in Singapore. Okay, you can go and take a look on this bank stock. Last week we talked about SIA. Is it good for dividend? Is it a good retirement stocks? Okay, you all can just go and like our YouTube channel. Okay, some of you all may see me on CNA and also hear me on 958. Okay, 城市频道. Okay, I'm also a trainer for IBF accredited program. Okay, which is called the Lifetime Income Mastery course. This is a course that actually teach on multi-asset planning on retirement. And due to this COVID-19, actually, our finance minister come up with the budget that 95% of the cost fee will be pre-funded. Okay, but for those that sign up for the course, means that you only pay 5%, 95% government pay for you. Okay, this is me. This is my 14 year in this industry. I'm currently the financial services director. Okay, and I teach out the Jurong East Investor Center, and I'm a dual license holder. Okay, just to recap, for those that have open account and you start to forget what it is, okay, there's something called Philips Cash Plus account. Okay, this Cash Plus account only started in this year January. Okay, this year January. So for those that have opened a prepaid account last time, you actually can choose to convert your prepaid account to a Cash Plus account. What you need to do is just need to log into your Points account and do a conversion. The commission rate will be lower than a prepaid account, and it stepped down some more. Okay, if you've got any queries on how to do it, you can just ask us. Okay, and for those that didn't receive our daily broadcast message, for those that are client of Jurong East, maybe because you didn't save our team contact, do save this contact so that you can constantly receive our broadcast. And we also have a Telegram broadcast for clients that are active. That means you have done 2 transactions per month. Okay, if you have done 2 transactions per month and you're not in our broadcast list, do let us know by sending a message to our team phone, and we'll add you into this Telegram broadcast. Okay, those that want to take this opportunity to open an account with the Jurong East team to enjoy all this benefit, okay, you can just scan this QR code. Okay, and or go to this website for to know more how to open account with the drawing team. Okay. Before I go into this session, let me just say something. Okay. Along the way, okay, along the way, I see. Okay, if you have any question, if you have any question, do type on the chat box. Okay, don't wait until the end, then you ask me question, then will be too much. And try not to discuss things during the chat group chat, the chat box. If not, I will miss the question. Okay, any question you just type on the chat box, and I'll just try to answer you the question along the session rather than wait for everything to then. Okay, is that okay? If okay, then everyone is ready. Then I just get started of this session. Okay. Okay, this is the topic today. Before I start, okay, what is unit trust? Okay, I presume some of you may be new in this session and don't know what is unit trust. Maybe I just do a short introduction on what is unit trust. Actually, unit trust, there's a word called trust that just I read also there's a word trust that it means that actually it's a pooling of money, okay, by a person called a fund manager that pull money from all the investor, and there's also a trustee to guard the investor money, and where they take it over to buy equity bonds and others. A bit different from REITs is REITs also there's a manager, okay, also the guard by the trustee, and they also pull money for investor. But REITs got another channel is they can also borrow money from the bank, okay, so that they are on leverage. But for unit trust, they can't do that. Okay, they can't leverage on that. And REITs, they are practically basically just only buy properties. Okay, but for unit trust, they are buying more of a liquid asset. They can buy a REITs fund, but not a physical property. So they can buy equity bonds and others. Okay, so that is how a unit trust have been there. They have been there for a few hundred years. Okay, started from the West, and now it become very popular globally. Okay, so there are, as it started very long ago, so unit trust, there is many different type of unit trust. In Singapore market itself for retail investor, there are more than 1,000 retail unit trust for investor to choose on. Okay, if you are a high net worth client, then you can even access to 50,000 unit trust. Okay, different type, more sophisticated unit trust can be a hedge fund unit trust. Okay, it can be even a hedge fund. Okay, for retail investor, there are about more than 1,000 for you to choose on, and they are very thin, but in broadly, they are only classified mainly as equities or bonds. Okay, these are the two main classification. If there's a mixture, then it's called a balance. Okay, and there's only two focus, either it's for income or capital gain, and some people say they want best of both, they want both. Okay, and of course, they got different country, different team, and different star. Okay, that depends on what the unit trust is. Okay, why there's no sound? The rest can hear me? Everyone, yeah, okay to, okay. So DP, maybe I think you need to check your system, okay, itself. Okay, 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 the rest all can hear me then, okay, that should be okay. Okay, good. Okay, I will just continue. Okay, so unit trust also got very different risk spectrum. Can be something that is very, very low risk to something that is very, very high risk. Very high risk like, can be even a derivative unit trust. There's certain special unit trust, they can long and short the market. Okay, but as a retail investor, I will encourage you all to avoid that type of unit trust. Okay, it sometimes can be very speculative, and some unit trusts also go on currency play. Okay, but that will be more of the sophisticated unit trust that they can also buy futures. Okay, but we are talking about more in general, the unit trust that invest in purely equities and bonds without leveraging. Okay, they only use derivative mainly for hedging purposes only. Okay, so that is a few range of unit trust in the aspect. And what is a good thing about unit trust? First thing, you get someone that's professional to manage for you, and it's not an individual. Actually, it's a team. Okay, and you may, it is so laggy. Is it laggy to everyone? Okay, okay. So okay, so okay, okay. So diversification. Okay, that's another thing you need to look at, diversification. Okay, and it really diversify out. How diversify? It means at you want to buy a corporate bond. you need 250,000 to buy a corporate bond. But just with $1,000 or sometimes even $100 per quarter, you can invest in 1,000 company corporate bond. Okay, that's how big the unit trust can be done. Okay, and there's different asset class that you can choose on. There's also alternative multi-asset class in the aspect. Okay, and liquidity. Okay, one thing about unit trust compared to ETF, okay, is you guarantee can sell, and you buy, you guarantee can buy in, and there's no spread. Okay, ETF is when sometimes it is a bit illiquid, there's a bit offer spread, and the spread can be widened. Okay, and can be widened also. Just like I think lately the market crash, I think some of the ETF the spike become very big. Okay, but for unit trust, there's no such issue. So guarantee everyone will buy at the same price, everyone will sell at the same price. So there's no differentiation when you all buy on the same day, all guarantee get the same price. Okay, and affordability, as I mentioned, it can be as low as $100 per quarter to invest in. Okay, that's how you can slowly build your wealth over time by unit trust aspect. Okay, but there's also a lot of people say about negative about unit trust. What are the common negative feedback people talk about is they talk about high fee and charges. Okay, let's look at what does that mean by high fee and charges. Okay, there's no free lunch in this world. Okay, if when you come to investing, be it you do it on your own or you get people to manage, there's also a fee you need to pay. That's something we need to know. Okay, even if you buy share yourself, you also need to pay brokerage fee. Okay, buy foreign share, you need to pay custodian fee. So there's always fee involved. If buy a risk, you also need to pay the risk manager salary. That's why there's a called risk management fee that I expect. Okay, so what are the fee involved for a unit trust itself? There's something called a one-time fee bought by investor. These are the fee that as an investor, when you want to buy, you need to pay. Okay, but how much you need to pay will depend. Let me just go to this type of, okay, first we call it initial sales charge. Okay, this is what we call upfront. Some people call it upfront fee. Okay, some people tell you set up fee. Actually, no matter what they use is actually called sales charge. And some people say bid offer spread. Okay, practically whatever word they just mouse the word is actually called sales charge. I mean that whatever you pay, there's something called a sales charge you need to pay. Okay, it can range to up to as high as 5%. That means $10,000 go in, $500 go in, need to be paid as a sales charge. Okay, that means some people say, before I invest, I lose 5%. Okay, and realization charge, that's another type of charge. Okay, which is not very common among all the unit trusts because most of the unit trusts are open-ended. Okay, however, last year I think they have launched some closed-ended fund. Okay, closed-ended unit trust. That means you buy already. If you want, and then they say that you must hold for 3 to 5 years. Okay, if along the way you want to sell it, okay, you must pay charges. Okay, that's called back-end charges. But the charges are supposed to decrease as you towards maturity. Okay, next is called switching fee. I buy fund A, okay, and I want to switch to fund B. Sometimes the RM or the advisor will tell you that, oh, you need to pay a charges for switching. That's called switching charge. So the switching fee also can range depend on where you get the source from. Okay, so this is something to take note of that. Okay, next, there's another type of fee which is called you don't bought by the unit trust. That means you don't see it on your side. That means you don't pay one. Okay, it's already pricing on the price you pay. It's a pricing on the P&L. There's something called a management fee. Okay, there's something called management fee, and there's something called a trustee fee. You don't see it on your own. You already pay off. Same thing like just like you buy a REIT. Okay, a REIT also have a management fee. A REIT also have a trustee fee. It's just that you are paying to the risk manager. Okay, so these were deducted from the income the REIT generated. So after they paying off this, then the balance will be given to you as distribution income, as a dividend income in the expect. So if the risk manager charge you very high, of course the dividend income will be lesser. So but you don't see, you only see net what you get. Okay, so this is something that we all tell investors, as long as they make the money, the return that you are happy with. So this may not be crucial for you at all. Okay, unless you say that you can perform better than the the manager itself to achieve that fee itself. Okay. Okay. So these are when you go to buy a unit trust, they always show you something called a fact sheet. Okay, I just use this fact sheet to illustrate to you what does mean. So you see something called front end load. Okay, here put front end load. Okay, actually it actually means sales charge. Okay, Singaporeans are very obedient one. When you look at the sales sheet, put there 5%. Or you buy already, you know that, oh, you need to pay 5%. Okay, then if someone tells you, oh, I give you discount, I charge you 3%, they're very happy. You feel that, oh, you earn a good deal. You only need to pay 3%. Sometimes they say, oh, I give you discount 1% to 1%. Well, then you become very happy to eat. Okay, but do take note, this front end load is printed on all the fund fact sheet. Okay, any fund will print. Okay, but do think of this money never go to the fund manager pocket at all. They don't take a single cent on whatever sales charge you put in. Let's say you invested 10,000, you are being charged 5% sales charge, correct? Okay. So actually the fund manager only receive 9,500 from you. Okay. They only receive 9,500 from you. Okay. But the 5% already paid to the one you buy, the unit trust you buy from. But on the statement, you recorded you invested 10,000 and you had negative loss of 5%. Okay. So, but the fund manager, to be fair to them, they only receive this and they just need to invest based on this amount and grow your money. But your statement, it reflects this. Okay. So this is something you need to think. A lot of people blame the fund manager for charging them too high. Okay. The fund manager didn't take a single cent from you on the front end load itself. Okay. Next is also the switching fee. This switching fee also not charged by the fund manager. Okay, it's charged by the salesperson that sell it to you. So the fund manager don't take a single cent on this also. They only take this thing called management fee. Okay, but management fee is already built inside the price already. Okay, whatever see the price you see is already net off the fee already. Okay, so that's something to take note. Okay, yeah. Okay, so that is a standard 5% still high is standard printed there. Okay, but if put it the other way around, if the fund fact sheet don't print anything, it prints zero, okay, I think you walk into the bank, walk into the insurance company, nobody will sell you unit trust because they earn zero. Okay, so that's why they put it there so that you some of them will just automatically will just need to pay it. Okay, the front charge is paid to the person. Let's say you walk to the RM sell you, right? It's the RM commission and the bank commission. You meet an insurance agent, they sell you, they charge you 5%. It's the insurance agent commission and the insurance company commission. On the financial advisor commission. So the fund manager don't charge anything, don't take anything from this money one. Okay, so that's something to take note. Okay, however, if you have a poems account, okay, if you have a poems account, you can see this advertisement, this on poems website. It is called what? Zero fee. What does this mean? Zero fee means that there is 0% sales charge. Okay, there is 0% switching fee, and there's 0% platform fee. Okay, so what I say with just now on this thing, right? You go to buy this same unit trust, particular unit trust in points platform, you can just cancel this off, and cancel this off, and you can yourself write zero there. Okay, it is practically zero. Okay, okay, so that depends on where you buy your unit trust from already. Okay, so that is what they mean by 0% sales charge. Okay, for those that are not aware, okay, okay, if the fact sheet never mentioned backend load, they don't have backend load is only for closed end fund. Okay, whatever fund you buy on poems account, there is no backend charges based on what I understand. Okay, for normal retail investor, there's only certain type of fund. Only they say they offer you only for a certain period, open only for 1 month, ask you to buy. After they say no, cannot buy anymore. That type of fund then got closed end charges. Some of the bank do that. Okay, they got they charge you front and they, of course they lock your money in and you want to redeem early, there's backend charge. So you see that is practically zero. So the same fund depends on where you buy and you pay zero cost. Okay, this is just a live example. I have to take away this fund name. You all take it. I ask you to buy this fund and then go and buy this fund. You go into poems account. Okay, this is just to show it's really zero, and this 0% is not a promotion. Okay, it's can say it's permanent. It has been there for years. Okay, a lot of people up to today still don't know poems. On Philip platform, you can buy unit trust at no cost. Okay, maybe I just emphasize again. On Philip unit trust poems account, you can buy shares and you can buy unit trust at no cost. What you see is what you get. Okay, so you can just see that this sales charge here tell you is zero. Okay, it is a real thing. It is not a fake thing. It's really zero, and you don't pay. So this is called the NAV price. Okay, this is the price. Okay, in the expect. Okay, okay. How we earn? Okay, that's for information that for all unit trust. Okay, unit trust, all the distributor. Okay, all the distributor. What the my distributor? Be it bank, be it RM, be it insurance agent, be it financial advisor, be it poems, okay, even our competitive platform, wherever you buy the unit trust to them, there's something called trailer fee. There's something called trailer fee, okay? We are being paid by the fund manager for that, okay? The company itself, Philip or bank, they are being paid. So if I want to earn more, I charge you sales tax, so I got two income. I got the trailer fee income, I also got the sales tax income. Okay, but for points, we don't earn this income from you at all. We only earn trailer fee, and practically almost everyone earn the same trailer fee. Okay, so the trailer fee is paid by the fund manager. It is part of the management fee the fund manager take from you, and they just give a cut to the distributor. Okay, this is a common practice in the industry. So the sales charge is just to reward the salesman from selling you the product. So the salesman also get an extra cut, a bigger cut, because trailer fee is very little. Okay, very, very little compared to the sales charge they charge you. Okay, so that's something that I hope that answer your question in the aspect. Okay. Okay, so the next question about people don't like about unit trust, they say lack of transparency. What do you mean lack of transparency? Okay, when you buy the unit trust, not like buying shares. Let's say I want to buy OCBC. Today, X61. I press buy at X61. I know that I buy OCBC at X61. That's the price I key in. I want to buy it, and I know the price I buy. So I want to sell OCBC. You go to X70. I press the sell button. I know I sell at X70. If you never hit X70, my deal is not done. Okay, so that's really called transparency in the aspect. Okay, but for unit trust itself, you can't see the price the fund manager buy. Okay, why is it so? Because you take note, unit trust, there's always something called forward pricing. What do you mean forward pricing? That's something called, okay, for unit trust, there's something called forward pricing. Okay, here I tell you that the price will make known on T+2. Okay, T+2, that is what my price now. Okay, it's a universal practice, depending on whether they buy an investment link plan with Asian company or buy anywhere from there's a timing called 3 p.m. There's a timing called 3 p.m. Okay, it's a practice that if you were to sell a unit trust today, okay, that's a side track. Last time I showed you the price. Let's say now that you see, you want to buy unit trust, you saw the price 1.975, right? Okay, they tell you this is the price, right? Okay, do take note, this price is 2 days ago price, not the price you're going to buy today. Okay, that's why they put indicative. That's why they always put an indicative. Okay, indicative price. So when you press a button before 3 p.m., you press a buy button or sell the button. After 6 o'clock, the market closed already. After 3 p.m., then today the market closed already. The fund manager need to compute, because they can have 50 stocks, 100 stocks. They need to look at all the closing price of all the stocks. From there, you look at what is the allocation, then they need to compute up, then come up with the NAV price, okay, with the net asset value price, which is why you can only know the price 2 days later. You cannot expect that the fund manager let you know I buy before 2 p.m. What is the price now? The market is not closed yet. So they were not able to tell you this, which is why it's called T+2. Let's say you want to buy a US unit trust fund. Okay, US not even open yet. It only open later 9:30, right? So if you have to buy it today, you have to key in before 3 p.m. Okay, key in the unit trust to buy 3 p.m. And you then wait for the US market to open. Then tomorrow morning 4:30 they close. Then you compute the price. So you are buying before 3 p.m. You press the buy button. You're actually buying for tonight the US market price. So the market not even open, so definitely you can't know the price. Okay, so it's always called T+2. But there's a general rule. For example, let's say I want to buy a China fund, a China unit trust fund. I want to buy today. Then I look at the whole China market. If the whole China market is rarely like crazy, yeah, today I buy the unit trust fund, will higher chance will be higher than the price I see that in as a liquidity price because the market go up. Okay, so if I have to sell, so now then you most likely you'll sell at a higher price. But if today the whole China market is coming down, you have to buy now, you buy most likely at a lower price. So that is how a unit trust works. So do not try to trade a unit trust. Okay, because you are not going into a no price in the expect, and a unit trust is very diversified in the aspect. So the pricing can be lesser than an individual stock price. So it's very hard for you to trade. Unit trust usually buy for longer term aspect. Okay, that's something to take note when you want to look at unit trust. Of course, the fund manager cannot manipulate the price. Okay, all these are MAS license things. You say the fund manager can manipulate, then practically ETF, REITs, everything can be manipulated. Okay, so no, there's no way they can manipulate because it's all unless you don't trust the MAS side, the governing side on the aspect. That's like buying a stock. Can a company director manipulate the price? I think that one I cannot comment on that. But for unit trust, practically they can't do that. Okay, especially for retail investor. For hedge fund, then maybe the rules to govern them will be a bit different. But for unit trust, you see no way that is way that so far we didn't heard of fraud case on unit trust. Okay, I have not heard of that since my 14 years in this industry. There's no such thing, no fraud case in that. Okay. Okay. Another thing that of transparency is because I say I buy a Singapore equity fund. I don't know what the stocks they buy. What you see on the fact sheet, you can only see, they only show you what? The top 10 holding, right? They show this is the top 10 holding, and the top 10 holding add together only 70%. What about the other 30% of the money they buy too? So you will not know. Okay. The one cannot be held also. You want to buy on the unit trust, you have to accept this fact. Okay, you have to accept it. You cannot say that the fund manager today go and tell you, oh, Mr. So and so, I today going to buy OCBC now. No way they can able to tell you, right? Okay, so you are not able to know, but you really want to know the detailed breakdown, then you go and look for the annual report, the semi-annual report. They will have all the breakdowns of every counter they buy and the transaction. The record is everything there. You want, you can go and scrutinize that, but you see nobody go and look at that. You just need to believe in their strategy, look at the track record, then this is what you can do. Okay, we have to also look at practical sense. You don't expect them to inform you on every cent. Okay. Okay. So there is something to take note on that. Okay. Okay. Whether a fund manager able to change the asset allocation percentage as and when they like, yes, of course they can do it because that's under their mandate itself. If they tell you that they're going to invest 100% equity, of course, let's say that, for example, this one, they got DBS 14%. Okay, OCBC, this is just example. This is just, let me just go to, okay. Let me just go back to this example. Okay. This is still take note that whatever is see on the fact sheet is already outdated. Just like whatever annual report you receive from the company, whatever quarterly reporting by any company is always outdated. Okay. Let's say the company closed at 31st of March, they report to you on April. Is it outdated? So this is also something like that. This will tell you that as of end of last month, what is their holding? So along the by you see this, maybe they sold off trim DBS to 10%. You only know that in the next fact sheet, next month they print out, then you know. So they can do what they deem fit in the expected, depend on their strategy. Some fund managers value strategy, so they buy and hold until certain profit, they take profit. Some fund manager is more of a shorter term, okay, or rebalance a portfolio. So they are allowed to do that in the expect, okay. But one thing you need to take note, okay, for fund manager, a lot, okay, that one I think I share with later part aspect, okay. How often they every month they need to print out this something called fact sheet. Is every month they need to update the fact sheet. So you can always download the fact sheet from the, okay, later I share with you Poem's account, how you can navigate and look at it. Okay. Okay. So that is, okay. Later I share some example of how the fund manager do. Now I just go on the concept on this aspect first. Okay. So the last one is called possible underperform of relative index fund. This is something very common. A lot of people will tell you, that, oh, I buy ETF. Okay. I buy ETF. Okay. This is someone that they will tell you that if I were to buy ETF, okay, they will tell you that because why you should buy ETF. Okay. Because most of the fund manager, most of the mutual fund manager, okay, two things they call most, cannot beat the market. Okay, they cannot beat the market. If they cannot beat the market, okay, then why you go and buy a unit trust fund that cannot myself buy the ETF that follow the market? Okay, but do take note, they tell you is the word is most. Okay, it is not 100%. Okay, so even let's say it's 80% cannot beat the market, then you look at it. Okay, what about the other 20% of the fund that can beat the market? Why don't you go and buy this 20% of the fund beat the market? Okay. And it's quite easy to find this type of fund that beat the market one. Okay. Okay. This is quite true for ETF side, especially when they're talking about the US market itself. Okay. Because S&P 500 itself is a very unique ETF itself. A lot of fund managers can't really beat the S&P 500. Okay. So you're buying a unit trust fund that compete with the S&P 500 on the US market. It is really tough. Okay, even a global unit trust fund to build the global index also tough. Okay, but we are in Singapore. Okay, we are in Asia. There is a lot of Asia fund. Okay, that can beat the Asia market index. Okay, so that is something to think. There is even fund that beat the STI index that invest purely on Singapore stocks and they win the STI index. There fund that invest in China market that beat the China index. Okay, there's fund that invest in Asia Pacific that beat the Asia Pacific index. Okay, that is maybe because of the Asia economy development and the company itself, and compared to the US side is a bit different, which is why there is quite a fair bit of Asia fund actually beat the market. So what you need to do is just need to find this type of fund. Okay, this is the later I share how to find this type of fund. Okay, on the aspect. Okay, and there's something to think. If you want to buy an ETF, just to let you know, you will buy an ETF, you are just telling yourself that I don't want to beat the market. That's what you're telling yourself. You're buying ETF, you just say, I don't want to beat the market. That is what, because the ETF will never outperform the market and they are always underperform the market but by a percentage, because there is a fee you need to pay for ETF. So you need to pay that. So that's why the ETF is always underperform the market by a fixed percentage. Okay, the percentage can be very small, depending on how much fee they charge on the aspect. Okay, I can share with you this because I'm a stockbroker from Philip Security. Client can get to me ETF, client can also get to me unit trust. So they get anything, I will not loogie, I will also earn. So that's why I can share with you in that aspect. Okay, if I on one side of the camp, of course, I only tell you what to look at. Okay, I'm not going to talk about ETF for today. Okay, maybe in the next session I'll then talk about ETF. What's a good ETF indicator in the aspect? Okay, and actually to be very frank, there's limited trial ETF is if you want to really buy what type of ETF you are looking at, STI ETF or S&P 500 ETF. Okay, so that is all unit trust fund. There's always something called against the benchmark performance. This is a unit trust fund. You can see this. What is so unique about this unit trust fund? Since 1997 until 2020, that's how many years? Okay, that's 23 years. These unit trusts have been around in the market for 23 years. And you can see this is called benchmark. Okay, this is called the benchmark. Benchmark is something indirectly, it's called the index, depending on what market they're competing in. And this is called the fund performance. Can you see it beat the market hands down over a long-term period? The market only give you a 290% return over this 23 years, but this fund give you a 469% return. Okay, how much extra return you get? More than 50% extra return. Okay, so that's something you need to think of. So there is this type of fund actually available. Okay, you can just go and find a list. You just see the chart, you should already tell no that this fund definitely win the market already. Okay, and this is a fund. You can see that since 1.4 to 1.9, you can see initially it performed as per the market. But after that, this is the benchmark. The market had outperformed the fund. Okay. So this is a global market, global fund itself. The market, so we can see that this fund actually underperformed the market. So all the fund fact sheet, most of the fund fact sheet will show you this graph. So by looking at the graph, you will know they have the reference to a benchmark to you to show it to you. So by looking at it, you know, oh, this one beat the market, this one to beat the market. Okay. Then of course there's also fund that on par with the market. You can see this fund actually go online with the market. Okay. There's some slight deviation, but the deviation is not significant enough. You can see that market go up, we go up, market go down, is on par with the market. And why you sometimes you need to consider buying this type of fund that is on par to the market is sometimes you can't buy the ETF. Or sometimes the ETF may be too small, maybe too illiquid, and may not be in Sing dollar term. And this type of fund you can buy in Sing dollar term. And the quantum you want to buy can be small, can be as low as $100, and don't need to pay brokerage charges. So this will be an alternative. If really on par, then you will need to weigh yourself. You want to buy the ETF or you want to buy the fund itself. Okay. So this is how you can spot it. You just go into the fund fact sheet, click it, see the graph. Itself will tell you the story itself. Okay. Okay. So what is the difference between a unit trust fund and a stocks and an ETF? So this is something you need to take note. Okay. Transparency, as I mentioned. Okay. Stocks are very transparent. ETF, because like STI 30 component stock, you know what 30 stocks they buy. Okay. But it also means that when they want to sell, you also don't know they sell and they don't have emotion. One. That's like if they want to kick out one of the stocks from STI 30 component stock, the fund manager just need to press the sell button and sell everything for the ETF. And they say A and I want, they just buy that one. Okay. But for unit trust, the fund manager need to decide what to buy, weightage on that. Okay. Individual stocks, definitely the risk is higher. Okay. Lower doesn't mean low risk. Okay. Some people get confused. Lower means lower risk. Because the risk is lower compared to buying individual stocks. Okay. Liquidity, ETF and stocks itself, it can only trade on secondary market. So especially ETF liquidity, you need to concern on that. You need to look at something called the bid offer spread. Okay. Bid ask spread itself. Okay. Stocks, you see, for high liquidity stocks, the bid ask spread is practically don't really have only the one bit different, but ETF can have more than one bit different. Okay. But for unit trust, because I guarantee can buy and sell. Okay. Same thing for ETF. I always want to say that the management fee itself for ETF, why they are so low compared to unit trust itself. So you must understand how they work, what the ETF manager really do. Let's just look at STI ETF. They didn't go and select the 30 stocks. Okay, the STI ETF manager don't select the 30 stocks itself. Okay, it's not determined by them. Okay, so when there's announcement that they're going to kick out that stocks, what they do, they just need to just sell off their stock and they buy their stock in just at market price. They don't even need to consider what price to buy. They just see what's the percentage allocation. They just buy according to percentage. Of course, you should not pay them too high. Okay, probably mainly look at operation role in the aspect. But for a fund manager, it's different. Okay, what they need to do, they need to do research. They need to do analysis. I have talked to one fund house. They told me every year they visit 3,000 over company in Asia Pacific. Okay, just to talk to a CEO, just to go to a company factory to take a look, make sure it's real thing, and then after they need to crunch the numbers, see whether this company can buy or not. The number of work involved for them to decide what company to buy is so much more, which why they definitely have to, but they only charge you slightly more in terms of percentage. Why? Okay. And okay, when we talk about stocks, you need to buy this. When talk about ETF, do take note there's something brokerage. A lot of people thought that cost, you need to consider there's brokerage fee. Of course, there's clearing fee, and there's something called custodian fee. If you were to buy a ETF not listed in SGX, okay, you buy an ETF listed in Hang Seng. I want to buy the Hang Seng index, I want to buy the China index that listed in Hang Seng because more liquidity. You want to buy S&P 500 listed in US AMEX. Okay, there is always a custodian fee you need to pay. It's $2 per month. Okay, and if you want to plan for whole long term, one is $24. This cost you need to add in, and also next thing is currency. Okay, but for unit trust, okay, here I say depends on where you buy, right? Okay, practically I'm from Philip Security, many Philip account client, our client, so practically it's zero. So what you see is what you get. So sometimes you need to add in this thing as a long-term cost you need to consider in the aspect. Okay, so let me see what question is. Okay, I didn't quite understand the question. What is the stocks? Okay, can you explain more on the liquidity of asset manager? Okay, for unit trust side, right? Okay, when you want to sell your fund, right? Okay, guaranteed they will able to liquidate and give back your money one. Because all the fund manager, you see, they got certain percentage as cash, let's say 5% as cash. For people who want to redeem one, then they can pass you back your money quite fast. And after that, then they go and rebalance their portfolio to see what need to let go. Okay, in the aspect. So that's why the liquidity is always there. So guarantee you can sell. Okay, same thing we want to buy. When you give them money, because they have the pool of funds, so they take it in, they may not deploy 100% of money in, because depend on, unless you give them very big amount, they only have 20 million, you give them 5 million, of course they need to deploy. So that's why the liquidity is definitely there, is guaranteed. It's sort of guaranteed in a way. Okay, just lately the crisis come, the oil price drop. There's one ETF, I think go negative, so almost like suspended somehow. But for unit trust, there's no such thing called suspended. Okay, in the aspect. Okay. Okay. Okay, when unit trust let go some of the price in the portfolio, yes, definitely you affect the share price, depend on how big the unit trust fund is. Okay, but unit trust fund manager also need to take care of the market integrity also. So they will know what to do. Just like for us, we also manage portfolio for our client. We also got a proprietary managed account fund. Okay, when we want to buy, we also cannot buy, say, I want to buy OCBC, I cannot just say I want to buy OCBC 860, everything, all this money just straight by 860. We will need to tell the dealer that we want to buy OCBC today. Just buy progressively in. It's not one lump sum, few million, just dump in and straight buy one counter itself. Okay, so that is what a fund manager do itself. Okay. Yes, management fee is the same. Okay, anywhere you buy the unit trust fund, as long the management fee is across regardless of where you buy. Okay, you buy it at DBS Bank, you buy it with OCBC Bank, you buy it Police Platform, you buy it with insurance company, the management fee is the same because it's the same fund. The only difference is the charges imposed by the person sell it to you is different. Some can impose you a back-end charge, some can impose you a sales charge, some can impose you an ongoing fees. Okay, but all this money don't go to the fund managers. Okay, so that's something to think of. Okay. Yes, ETF is traded on a stock exchange. Unit trust you can't trade. Okay. Okay. Do investors get? This one I'll talk about later. Okay. So let's look at how you select a unit trust fund. Okay. Let me just give you this example. Okay. This is a common thing that people always ask me about that. Okay. If let's say you got two unit trust fund, both fund invest in the same country. Let's use country C or sometimes use China example. One fund is price 160, their price is 120. Which one will you buy? Okay. If you buy stock, some people say, oh, this stock is 20 cents cheap, that stock $1 is too expensive. So they prefer the cheap one. Okay. But unit trust, you don't look at this price alone itself. Okay. You need to clear that aspect of that. Okay. If you were to, you need to look the other way around. Unit trust fund, when you don't pay dividend, that type of accumulation fund, the price supposed to go up. All unit trust fund will launch at $1, $10. Okay, the price should only go up higher and higher over long term. Okay, if you buy a unit trust fund that launch at $1, 10 years later they tell you the unit trust fund is 90 cents. Something is wrong with the fund. Okay, if the fund is not paying dividend, okay, the 10 years later the fund should be like more than $1 one, $1.50, $2. That should be how the unit fund go, because they need to grow your money. So if these two funds happen to be launched on the same day, same time, same year, then you can say, how come this one 160, this one 220? I mean, this one outperform this company, this fund itself. Okay, but you see, you don't cut to find both fund launch at the same day. So sometimes maybe this one only 3 years old. This fund only 5 years old. So the price 160 and 220 don't tell you any story about the fund already. Okay, so that's something you need to take note. Don't just buy on price. A lot of people always ask me, Darren, what is the price of this fund now? Okay, I always tell them I don't know the price one. I don't look at the price of the fund because it is not critical and it's not important at all. Okay, you just need to know the market. If the market got upside potential or downside potential, that is one to know that more critical. And how have this fund performed during market crash? Okay, so that's something to take note. Also, another thing that we need to take note, there's a lot of new fund. A lot of people say, oh, the fund is launched, new is very cheap. So they prefer to buy new fund. Okay, new fund launch at $1. Okay, do take note. What does new fund launch at $1 means to you? Okay, all fund must launch at $1, but you see a new fund will always launch what when the market is usually on the higher side or when there's a demand like tech going on the high side, then the new tech fund will launch. Say, oh, you want to buy a tech fund or $1. Okay, you're buying at $1 means that you're buying, giving you the money, they go and buy the tech stocks now at current high price. Okay, so that's something to take note. So you don't expect to have that like IPO mentality, like you like buy a stock, you buy today, hope that tomorrow IPO the stock price will shoot up. Unit trust, no, this thing don't happen. In the past, even worse. After you buy, the price drop because there's expenses you need to pay. The marketing cost, the charges, all this need to pay. Okay, but now I think they have amortized it over time, so you don't see a dip when launched. Okay, but do take note. Don't think it's new is good. I usually tell people don't buy new funds. Just like I always tell people don't buy new REITs. Why is it so? Because there is no track record. You don't even know they perform good or not. Okay, you also don't know this fund manager, how is his track record in the past. Okay, because this fund is new to him also. Okay, so always buy things that is in a while for the market at least 3 to 5 years. Just like I recommend using my REITs class, always emphasize, don't buy a new REITs, buy a REITs that have been there for a longer term, so you can know that they actually can perform. Okay, so same thing apply to unit trust aspect. Okay. Okay, unit trust with dividend don't normally appreciate, depends. We'll talk about that later. Some will appreciate, some don't appreciate. Okay, depend on how the unit trust launch. Okay, how Peter, I talk to a bit later. Okay, so that's how we evaluate fund. So this and now we look at it. Okay, then we don't care about when they launch. Now we look at this fund. Let's say I say this manager A able to give 15% return. Their manager able to give 12% return. Who is better? Okay, don't just use return as a gauge. You need more information. The Sharpe ratio of manager A is 1.25. The Sharpe ratio of manager B is 1.4. So what does this tell you? Okay, this tells you that actually manager B is better. Sharpe ratio is a measure of risk adjusted return. Means the manager able to take lesser risk to give you better return. Okay, some manager able to give high return because they are very aggressive, so they take very high risk. We will talk about that later. Okay, how you identify the aspect. So this is something to take note. Okay. Okay, so let's talk about real thing. Okay, let's talk about the real thing about unit trust itself. Okay, let me go to this file. Okay, and let me go to this file. Okay, so everyone can see this file, this Excel file. No, I haven't shared it. Okay, everyone can see the Excel file. Okay, okay. So this is okay. I purposely remove the fund names. Okay, because this is also on YouTube Live. Okay, so I don't know who is watching, so I have to really remove the fund names itself. But if you want to know more about fund, you can talk to me separately. Let me just do a filter to show you how we look at fund itself. Okay, let's just go to one category. Let's say we go to equity. Okay, let's just look at diversified. We look at simple. Okay, look at fund that invest in the Asia Pacific region. Okay, Asia Pacific region. Okay, okay. Let's look at CPF OA approved fund. That means you can use a CPF OA to buy one. And we only look at Sing dollar. Okay, so actually like that, you see, you zoom until become not much fun. So what we look at, okay, forgot about near term. Okay, near term, of course, everything drop. Okay, but you really want to take reference to near term, then you look at how it dropped. This is which date? This is based on, this is May. This is based on early May date. Okay, early May date, the market have dropped. Okay, every index has dropped, but look at the drop. One fund can only drop 8%. Okay, that means it recover back, and one fund is still losing 23%. So you are buying this, both are CPF, we are buying the same fund, in different fund, but both invest in the same sector. Okay, you can see there's a big disparity. The top and the bottom, the difference can be a few times more. Okay, so that is something to take note on that. Okay, then we just go. I always want to go further one. Okay, let's look at longer term track record. So those funds that are too new, we just ignore them. Okay, look at, okay, this is a return including dividend. This is called total return. What I see here is that some of the fund pay dividend, but everything is reinvested. Okay, you can see the return is not high. Okay, why the return is not high? Because we have been through a market downturn. Okay, where the whole market dropped a lot. So you can see that the return actually, because average over 5 years become down a lot. Just like some of the REITs you buy 5 years ago, now it's negative. Even you increase dividend add together, you still lose money. Okay, so this is how we look at. First, you look at returns. Who have better returns? This one 6%. Okay, 6% means that 6% return per year. Okay, that means if you buy this fund 5 years ago, at current market juncture, actually this is not latest one. The market have moved back. This is, I think, 1 month ago. Okay, if you are still holding a fund, you are still making 6% return per year. So you're still sitting on 30% profit. Okay, despite the market have come down a lot. Okay, if you were to sell it earlier, of course, you make even more. Okay, but then you look at this thing called standard deviation. Standard deviation is what we call risk. Okay, we don't care about the rest first. We only look at these two, because these are the two information that as a retail investor, you can easily find. Okay, you can easily find this information. Okay, you can see the standard deviation is 15%. What does it mean? It means the risk is 15% up and down. Okay, compared to the second fund, it only give you how many percent return? 5% return. So the difference is only 1%, 1%, right? Okay, 1%, right? But what is the standard deviation? 11%. So do you want to get an extra 1% return by giving yourself an extra 4% risk for one direction? Okay, so this is something you need to weigh on it. Okay, but of course, you look at it, the rest you can just ignore already. Okay, I invest 5 years, I still lose 4.5% per year. Okay, so so by looking at this filtering, you will see that this fund itself, that's why I need to take off their name. You know, you see it, then may not be so good. This fund you can just show, I can just throw one side already. The track record show that they are not performing over the past 5 years. Okay, but these two, then you can look at it. Are you willing to take the risk to get higher return? So that's one thing you need to zoom in. Then after that, we need to zoom into 3 years. So you just focus on these two funds itself. Let's just focus on these two funds. Okay, then look at it. Okay, then 3 years actually the one that take higher risk one, the return lower. Because the fluctuation is higher. So this one become more stable. So that's how we look at fund itself. We have to look at 5 years, 3 years, then we look at how it goes. Of course, then we look at near term itself. Okay, and it happened to, this one actually is the one that dropped the least. Okay, it is recover the best. Okay, because all the work consistently, the standard deviation is on the lower side. So that's something you need to, that's a simple way you do this analysis on this. Okay, okay, let me just look at, okay, this spreadsheet is not downloadable from Philip website. Okay, this spreadsheet is what I have. Every month we will have the data refresh. That's how we manage our client portfolio, because we have all this data in it. But you can find the returns and standard deviation from Philip website. Later I'll share with you how can you. Yes, the return is including the spreadsheet. Okay, let me just go to, okay, so you don't look at Sharpe ratio, you just look at standard deviation. Let me just go to Philip website. Okay, hold on, I need to, okay. Oh, yeah. Okay. Okay, all can see this Poems account. Okay, let me just go to, you can just go to this tab called Unit Trust tab. Okay, just click all. Okay, there's 38 pages, 1 to 38. So which why I say there's more than 1,000 unit trusts available in the market. Okay, let me just expect the similar thing. You just go to equity. Okay, do take note, this is just a demonstration. Doesn't ask you to buy any of this unit trust fund. Okay, let me just go to CPFOA, SGD. Okay, you can look at it. Okay, you can see there's a 3-year return here. Okay, and there's but here only have 3-year return. Okay, but do think about you. Philip website is very unique. Okay, negative one you can just ignore. Okay, let's just look at this example. Fidelity. Okay, this fund tell you is you just right click. Okay, you go to fund info. Okay, itself. First, you need to come see below. Below means that this fund don't pay dividends. Okay, this fund don't pay dividend. So it's supposed to move up and up over time, which why is $2. It launched at $1. That means over the year have increased 100% in capital already. Okay, it launched at 2015. That means over the past over 5 years, you have made 100% gain in capital. If you buy at Jan 2015, launch price. Oh, sorry, launch price 1587 because Philip only come in this price, but you have to check on that. Okay, so this will tell you this is the returns. And this is the volatility. So you can see 3-year, the return is 4%. This fund, not if you live in less than 5 years, so you don't see this reading here. Okay. So you can see 16%. Okay, 16% volatility, and this is the return. Let me just go back to here again. And you want to see the fund detail, just click on the fund fact sheet. Okay. You will tell you the chart. This is how the fund perform, this is how the benchmark perform. Okay, you can see that you beat the benchmark lately. Initial part don't have, is on par, but lately beat the benchmark. And always ignore this thing because you are not paying any sales charge. Just look at this return over the index, which is below. Okay, you can see that it beat the index. Since launch 6.2, index only 5.3, 8.5, 6.8, 12.9, 10.1, 22.4, 16.9. Okay, you can see that it beat the index. Okay, you don't look at 1 month, 3 months, that one is too hard to gauge. Okay, but I look at the longer term, it beat the index consistently, even 1 year, 3 year, 5 years since launch. Okay, so this is a fund that you want to look at that beat the market itself. Okay, okay, this is one of them, but you just need to take a look. Let me just go back to, okay, let's just look at this fund. First state dividend advantage, here tell you is only 0.1828%, right? So you need to go to here, okay? One thing very unique about Philip platform compared to other platform that, okay, I think other platform you'll not see first state dividend advantage give you 0.18%, okay? What they indicate here is purely just based on price return, okay? Price return. Okay, what does price return mean? That means there's dividend here, right? They didn't add in a dividend. So just now you see that Fidelity Fund, no dividend. So what you see, that one is a total return. That one because the dividend you invested. So first day dividend advantage, because they got this dividend, they pay to you already, right? Okay. It assume that you take a payout options, but you were to reinvest your dividend. So the dividend is about 4%. So you need to add the 4% here. So it become like 4.18%. Okay, because you reinvest the dividend. Okay, so that's something you need to think note of this. A lot of people will confuse 0 and 4. They choose that they are on 4-1 because that one is higher return, right? But to think note, this is exclude dividend and your volatility actually is lower. Okay, just now that one I think is 16, right? Okay, so this is how you look at it aspect. Okay. Okay, so can have an idea of how you can find this. Okay. Do you recommend client any unit trust? Yes, we recommend because we manage client portfolio. And if our Jurong East client, you can always apps us and we actually can advise you. We can even review what is your unit trust portfolio on the aspect. Okay, so that is how we look at a simple way to look at unit trust. Okay, let me just go back to here, the slide itself. Okay, next, a lot of people buy unit trust not really because of the gain. They buy unit trust because of the dividend, okay, which is what I need to share with everyone. When you buy the unit trust, this is based on 30th of April, okay, the dividend yield. Okay, you can see this is the dividend yield itself, right? Okay, 10%, 9%, 8%. Okay, of course, all the way down. Okay, don't ever buy a unit trust just because of this yield. Okay, that is, I repeat again, don't ever buy a unit trust just because someone told you that the yield is 8%, 9%. Okay, you have to think of it, what the unit trust buy, what the unit trust manager buy for their unit trust itself. Okay, they buy actually just buy, they buy equity, right? They also buy bonds, correct? So where can they find an equity that 8% one? Where can they find a bond that gives them 8% dividend one? Okay. So you need to tell yourself, where can they find? Where can you find? If they can find, it means you also can find, right? And you don't only find one counter, they buy 100 counter, 50 counter, 100 counter. So they can find so many counter that give them. So you need to think, where does the dividend come from? That's something you need to think note in this aspect. And it is a common practice, okay, in the unit trust industry, in globally itself, when there's something called dividend pay to you. Let's just use a fund that pay equity, they buy equity, okay, and they also buy bonds. Okay, let's just take a balance fund itself. And they told you that they say that, let's say they say they pay you 8% dividend. Okay, based on the price, okay, based on the price, 8%. Then look at, can it really generate 8% dividend from the investment they get? Usually don't have one, okay. So maybe they say that they're able to generate 6% dividend from these two parts. So there's still a shortfall of 2%, right? They need to pay, right? So where they can pay you, there's always something called capital gain, because they make money, so they take the profit and give you the 2%. So easily you can get the 8% dividend. Okay, but do take note, capital gain. Capital gain only happen when what? When the market is going up, correct? Okay, what happens when the whole market down? You will have capital loss, correct? So capital loss, how they going to pay you this 2%? Okay, because your price already dropped already. And when the whole market come down, your dividend may also cut, maybe cut to 5%. So that means they need to pay you a shortfall of 3%. So where are they going to take this money to pay it to you? Okay, the way they can pay it to you is take from your capital. That means called return of capital. What does return of capital mean? They mean they sell off your investment and give you money back as dividend in the extract. So what will this will happen? This will happen to your NAV price drop faster. And it will happen when the market is down, at the time they sell some more, it drop faster. So that is something you need to take note of that, okay? Don't just see that, wow, blind by 8% dividend, 9% dividend, 7% dividend, go and buy. You have to look at, tell yourself, is it practical to achieve that dividend? Okay, if it's so practical, then you can do it yourself already. Okay, so that's something to take note. And this is a standard practice. Okay, how can you spot unit trust that pay capital, okay, that take out capital and pay for a dividend? You just need to look at the graph. Okay, one thing I like about Poem's platform, because they show you the graph is just purely based on what? Price. Okay, other place show you the graph based on what? Total returns. So you can't even know that they are paid from capital because it's all up. Okay, so you need, points only show you based on price. That means they already minus, okay, they already minus off your dividend. They just give you the price itself, minus off dividend already. So how can you see that? Let's say you buy this unit trust that pay you good dividend, then just look at past few years. Okay, now it's a very good gauge because the past few years before the market crash, the stock market have been moving up. Okay, have been moving up, correct? Okay, so you look at the unit trust you buy. Okay, this is, let's say you buy maybe 3 to 5 years ago. Okay, that is your unit trust price itself. You look at your price 3 to 5 years ago. About poems you can plot 3 years, 5 years, 4 years one. Okay, what is the price? Is the price also like this? Follow the market, and you're still collecting 7-8% dividends. Okay, okay, or is the price like this? underwater. You are suffering capital loss, and the capital loss sometimes can be even steeper one. Okay, you're suffering capital loss. Then look at the whole market have been moving up, and yet my unit trust have been losing money. Okay, so this may be this may be one of the sign that they may take capital and pay to you, which why cause it to drop. Okay, so that is something you can go back and analyze on your unit trust you buy. Okay, from that aspect. Okay, if you're not sure on that, you can actually look for me or look for us. We are able to help you to dissect. We're able to show you how to analyze on that. Okay. So far so good. Anyone got any question? Okay. So next, you always advocate that unit trust you need to buy on a regular basis. We call dollar cost averaging, and every month $100 can buy, $100 can buy. Actually, I'm doing that myself also. Actually, not I'm all the while doing that on my own for my own money. Every month I just invest every month, and this is what is good about dollar cost averaging. Long term wise, it will definitely give you good return. Okay, but do take note, dollar cost averaging only work in this way. Only work in this few scenario. Okay, you only work when it is going up. Okay, you do dollar cost averaging. Why? Because you don't know when to buy, when to sell, So net you'll go up one night. So you are reducing your volatility of your investment. You are calling buying insurance for investment. Okay, dollar cost averaging can also work. Okay, if it's sideways. Okay, by doing that, actually we have done the study. You do a dollar cost averaging, ultimately actually you can go up this way. Okay, but what dollar cost averaging don't work, okay, is the fund is history is like that one. Okay, don't think of something called average out, average out, average out, average out. Okay, some of the fund is very obvious that you average out also no use one. Okay, so don't do cost averaging on this type of fund. But the other two category of fund, you can do it on the aspect. Okay. Okay. So why a lot of people buy unit trust and lose money? Okay. Okay. Yes, actually now lately got some of the high net worth unit trust fund got some problem. Okay. I lately got one unit trust fund, they freeze their NAV. But that's for the high net worth fund because there's some derivative involved. Okay. So market downturn, they freeze. And some of them can even drop 50%, 70%, because they got inheritance derivative inside. But for all those retail unit trusts, you don't have that worries in the aspect because you see they are not allowed to have that type of thing inside. Okay. So that's how you look at it on the aspect. Okay. And if the unit trust problem is you just need to look with the market. If the market is going up, how come the unit trust drop a lot? So maybe sometimes the fund manager may buy a wrong counter that this counter go bust. Okay, so that's one thing you look at the NAV. Yes, you have to look at the NAV. Okay, why investor lose money? First thing of they buy and forget. They buy already, assume that you've been taken good care of, then they forget about what they buy. Okay, this is good that just now I show you that there's one, the unit trust, the 1997 up to 2020, right? It outperformed market by 50%. Then when you buy and forget, I think you got no worries. Okay, but there is quite a handful of fund is this way one. Okay, but not all fund are like that. So you cannot forget what you buy. Along the way, you must really buy and sell. Okay, then assume that unit trust always give a positive return. That is something that a lot of people think. I invest, I get the fund manager, I expect them to make money every year. Okay, it is not possible. Because what they buy is purely stocks and shares and bonds. The whole market come down, they can't even short the market. You cannot expect them to give you positive return when the market downturn. But you look at longer term time, have they been performing much better than the market? So that's something you need to take note, okay? And that's why you need to constantly review the fund itself and how they perform against the market. Okay. This is just theory. Let me just show you how you can, okay. This is not updated data, okay? This is not updated data, but it just give you a good gauge how you want to build your interest portfolio. This is focused on dividend. This is focused on dividend. Let me just share with you the Excel file first. Okay. Okay. This is okay. this, for example, you have shortlist 11 fund, okay? Then you just need to, what you need to do, okay, for retail investor, you don't need to do so many, because I don't think you have the time to analyze so many things. So you just need to look at, I use 3 years as a standard example. Okay, you just need to look at volatility where I share that you can get from it. Okay, analyze return you can get from maximum drawdown. That one you need to look at the chart, see how fast, how much have we dropped. Then you can just extra estimate. Okay, dividend yield you can compute yourself in the Excel. Then you just need to come up with this Excel file. Okay, and just need to look at what are you looking at. Okay, let's say I buy fund B, fund D, fund G, fund I, fund J, fund K. I put into this 6 fund. Okay, then I look at the volatility, 6.69. Okay, 3-year annualized return is 1.42. Why? You have to understand the market have come down. Okay, come down a lot. So you need to give a discount to this. You can see this one only still 3 years still got 9%. I mean, before the market crash, actually they are double digit. Okay, so the maximum drawdown, this is something you need to think. When the market down, it can down 9%. I think this is the latest data due to the market crash. So imagine the whole market have crashed already, and you're buying this portfolio itself, you only down less than 10%, where the stock market have down 20, 30%. Okay, and your dividend yield is about 4%. So this is how you, then you just need to adjust to the one that you are more comfortable with. Okay, okay, let's just use this example. Okay, you can see by just increasing the volatility by a bit, I increase my return by 2%, but my maximum drawdown I increased by 3%. Okay, so this is how we need to structure your fund in the expect. Okay, different category, and just use the Excel spreadsheet to plot on this expect. Okay, I have all the data because just I just throw everything in, then I can just choose a fund from 1,000 fund and I just select on this expect. Okay, what you can create on yourself. Okay, okay, so that is some. Okay, after buy, dollar cost averaging, when to sell. Same thing as when you buy a shares, when you plan to sell, you need to have a target profit in the expect. Okay, also depend on whether does the profit make sense. If $100 per month, dollar cost averaging, usually we recommend you need to hold at least 3 to 5 years. Okay. Yes, 3-year volatility percentage is considered low. Or what 3-year volatility? Okay, usually I look at volatility portfolio basis to be single digit. Best is around 5 to 6%. Okay, do take note the volatility of 5 to 6% means one standard deviation only. Means you only swing 10% maximum. But at current market juncture, you swing 30%. Okay, because one standard deviation, now current market is 3 standard deviation. Okay, so that is something to take note. Is it safe to buy unit trust now given the COVID-19? Okay, same question. Is it safe to buy stocks now? Because they are in the same direction. Okay, you believe the market will recover over long term, you want to buy stocks, then you may want to buy unit trust also. Okay. Okay, so that is something to take note. Okay, on the Poems platform later, I share about how to do reinvesting on this. Okay, so you see, you don't buy more than 8 funds unless your capital is very big. Okay, even a 250,000 account, we also tell them that you buy 8 funds, maximum 10. Diversification is good, but over diversification will lead to no returns. Okay, your return being marginalized in the aspect. And there's something called rebalancing. This is something that we all share with our client, that when there's market go up, okay, you need to rebalance back your portfolio back. That's when they sell high and buy low in the aspect. Okay. So that is okay. Any other question? Okay. You all got any question, you can just type on it. Okay. Someone asked me how to choose rebalance. How to, when you buy, let's say this Poems account. Okay. Okay. Anyone got, you all got any question, you can just type. Okay. Then you can choose to reinvest or withdraw. Okay. In this aspect. Okay. Back to just Irene question. Is it safe to buy unit trust? If you are going on an RSP approach, actually it is quite okay. Now every week I using my special account to buy a unit trust fund. Okay, every week, and then there's no cost. Every week I just buy on a weekly basis. Okay, and I buy it since March to now. Okay, okay, but you must remember to sell. I buy since March to now, and now the return is about 4%. A special account interest is about 4%, but I only buy for 2 months. Okay, so that's how it, but of course, there's a time that when I need to sell, I just sell it off. So that is something you think. And every month or every 2 weeks, I'll use cash to buy certain unit trust fund. Okay, on a regular basis. Okay, so that's something that rebalancing is using switch fund. Yes, rebalancing is just switch fund. Okay, just switch your fund, and there's no charges. So one thing good about unit trust is it's very easy to do rebalancing compared to stocks. Okay, but stocks when you want to rebalance, you got an issue of how much you need to sell. You sell too little, the brokerage fee will kill you. So hard to rebalance. But for unit trust, it's 4 decimal point. So it is very easy to rebalance for unit trust aspect. Okay, compared to stocks itself. Okay, let me. For those who already have got poems on their with their own advisor for shares, can they buy unit trust to you? As long you can, in Philips Security, you can open multiple poems account. Okay, you can open an account with a drawing each team. Then we can actually advise you what to buy. Okay, in the aspect. Okay, when to do rebalancing, usually we will rebalance every 6 months to 1 year. Or okay, there's 2 ways to rebalance. Maybe I just use this aspect. Okay. Okay, rebalance, you see, first thing you look at, some people say fixed time. Okay, I mean, you need to set a fixed time, maybe 1 time per year, once per year, if you look at long term, okay, or percentage change. Percentage change, let's say you got an equity and you got a bonds. Okay, let's say if the 50-50, if it can go to 60-40, it's a big change. Okay, so you set a percentage, can be 5%, 10%, then you do a rebalancing. So that is something you to take note. Okay, some people like to do fixed time, some people like to do percentage change. Whatever you do is, this is mainly for the longer term. So you need to stick on to your thing. Don't this year you go and do fixed time, next year you're going to do percentage change, then after next year you're going to do fixed time. Then actually it defeat the whole purpose. Okay, so there's something to take note of that. Okay. Let me, okay. I just continue type of question now. I try to answer one by one. Okay. But before I continue to answer the question, maybe I just share you, this is what we do for our client. Okay. We got something called advisory account. Okay. For those that have poems account, you want to DIY, yes. If you are a client, you can just contact us. We can actually recommend you what to buy. But usually we recommend more on the safer side one, because we don't know how you're going to manage it. So you're looking at something for long term. But for those that want us to manage for you, you say you don't have time. We got unit trust wrap account services that we are targeting 4 to 5% dividend payout every year. Okay, of course we'll select fund that don't pay out dividend from the capital because we want a capital preservation. Okay, so and for those that don't want unit trust, they say unit trust they can do on their own, but they want us to manage a stock portfolio. We got another stocks advisory account that we decide we manage your stock portfolio on an ongoing basis. That means we decide what to buy and sell for you. Okay, especially the current market situation, maybe there's opportunity. Okay, but you may don't have the time, or you may unsure what to buy. We will decide. We can able to help you on that. Okay, and we got the last services called the managed account services. Okay, this is an account that is a hands-off account that will decide what to buy and sell on unit trust stocks, be it Singapore market, US market, and Hong Kong market. Okay, it's a hands-off approach. Okay, if you want to know more about any of the services, you can just contact us. Okay, anyone got any question? Okay, if not, okay, I'll continue answer the question. If you got any question, maybe you can just, you want us to take a look on the portfolio, okay, or you want to know more about our services, you can just scan on this QR code and just submit your response there, then we'll get back to you. Okay, meanwhile, I'll try to answer the question from top down. Let me see which question start first. Okay. Okay. Dividend payout fund. Okay, from Jason, if hold more than 15 years and above, can come back the principal loss if fund won't grow. Well, right. That depend. Okay, that depend. Just like we talk of certain stocks that some people buy a stocks. Okay, after 15 years already, the dividend they collected, plus the stock price drop, they also lose money. So that will depend. And also that provided the fund still around after 15 years. Okay, if the fund is keep on dropping out, maybe on the 10 year, they will just close the fund. They close the fund, they have to realize the loss. Okay. Okay, so okay, Hitman say, can you share what you buy? Because we try not to openly tell people what to buy in this webinar. Okay, but then I share with you one of the fund. I just use the illustration to share one of the fund. That's a fund that you can consider. Okay, for longer term, you go and look at the track record. It's about 8% to 9% return per year over the past 15 years, and CPF OA can buy. Okay, that's one of the fund that you can buy already. You can peacefully put one side. Don't look at it in the near term because near term market will swing. Okay. What if I do like to buy bonds as the return are very, what if I do not like to buy bonds? Then you can just purely based on the equity aspect. But usually you prefer a balanced approach. Sometimes a lot of people say they don't buy bonds. Okay. But you can look at your portfolio as a whole. If you take your savings or CPF as a bond portfolio, it can be also considered. And unit trust, there's a lot of equity fund for you to choose. Okay, if buy every week, so can't use dollar cost averaging, and there's a minimum, right? Okay, to buy every week for unit trust, minimum is $100. Okay, no need to be more than 1,000. Every $100 you can buy a fund already. Okay, and there's no charges. So let's say you got $1,000. Okay, you can buy 10 weeks. You can buy over 10 weeks. Okay. You see people rebalance 12 months and above. 6 months sometimes it be too fast, because if you are diversified portfolio, you see the swing will not be that big. Okay, so how the portfolio, just I show you one example. Okay, how do you contact me? You just send a QR code and can talk about this. Okay, which one? Okay, management fund is managed by a team. Okay, or the advisor help me open the account. The management fund actually is helped to manage by our team itself. Okay, actually I'm the key person on the unit trust portfolio and the managed account portfolio. Okay, but we have a team to do it. Because we have a fund manager itself. Okay. Okay, so okay, is fully invested income fund safer than equity fund? Okay, example, shoulder Asia income fund. Okay, need to buy. That one may not be that good. Okay, maybe that one I need to have a separate discussion. Okay, maybe let me just continue first. Okay, because I'm not end yet. Okay. 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 When talk about portfolio, right, we all talk about unit trust fund itself. So we always say that you need to build unit trust fund as part of the portfolio itself. Okay. To build out your balanced portfolio. When talk about dividend, a lot of people buy unit trust for dividend, but do think no, unit trust also lose money when the market come down. So you just need to make sure that you have this type of paycheck and paycheck for you to sustain it. Okay. And then after you look at the dividend income on that aspect. Okay. So how you want to select better unit trust on stock itself? As I mentioned, that actually I run this lifetime income mastery course. Okay. I've been running this since 2017, more than 3 years. Okay. And this course itself is a IBF approved course. Okay, so what does IBF approved course mean? For those that don't know what is IBF, IBF is called Institute of Banking and Finance. Okay, it is in the MAS building. It's a statutory board directly under MAS. That means in a way it's government. Okay, in a way it's government. Okay, this course is fully conducted by me. Okay, and what does this course teach? Actually, this course actually is a 2 full day course. First thing, it teaches you how to manage your own finance. You must know where is your money is. A lot of people say, I work so hard, but I don't have savings. So this course will teach you need to tidy up your finance, know where your money is, and are you paying too much for insurance or are you undercovered? So you just need to tidy up on the insurance aspect, need to know what are the critical plan you need, and some of the redundant plan, are you buying too much? And we'll talk about how to maximize CPF and SRS, especially though approaching 55. How can you maximize it, okay, to earn higher return on this aspect? So these are on the personal finance aspect. Okay, the second part of this course is talk about multi-asset. We'll talk about bonds, REITs, stocks, unit trust. It is not more of how to select. what are good unit trusts, what are the good stock, what are good REITs, what are good bonds to buy, okay, on the fundamental aspect. Of course, you need to know more about something called retirement plan. There's also good plan, lousy plan, how to identify them, and from there build a portfolio. Okay, this selection is just one thing. Like everyone know that bank stocks long term is good, like OCBC, DBS, UOB is good, okay, but the price you buy, that's another thing. You buy DBS at $30 and compared to someone buy DBS at $18, so there is a big difference. Both DBS are good stocks, but it's the price you buy. So this course not only teach you how to analyze good stocks, good REITs, good unit trusts, it'll teach you what is a better way to enter the market. Okay, using very simple technical analysis. This is not a trading course. I need to emphasize this is not a trading course. Okay, it's just truly a simple way that you can enter at the market at a price lower than what most people will buy in the expect. Okay, so that is what this course teach. And after that, it teach you how to build really your multi-asset portfolio. Okay, how to build your portfolio using this asset class. Okay, after these two full days, some of you, we always encounter some of them we still confused. Okay, and this course we only talk about Singapore market during this two full day because we can't talk about foreign shares, not enough time. Okay, but there is an ongoing review. There will be a revision class after this course. Okay, we actually mean to recap, review, and reinforce what you learned. Plus, we will can use this understanding to apply onto foreign shares. Like selected Hong Kong counter, selected US stocks. US stock is good for growth. Okay, Singapore stock is good for dividend. Hong Kong stock is good for dividend, and some of them are good for growth. So you may want to have a diversified portfolio, diversify some money overseas. So this revision class will able to add in more things in the aspect besides looking at Singapore stocks. And of course, you need to build your own portfolio. This is not I build for you. Okay, you need to build your own portfolio. After you build your own portfolio already, you can get back to us and we'll review to you and give you some advice. But ultimately, it's you decide what to do, not me decide what to do for you. Okay. The tools I've been using for the past 14 years for my client to help them to plan for retirement to build their portfolio, I'll give it to you. Okay. You need to have an Excel software to open it, and the formula, all the cell will not be blocked. So you actually know what is the formula behind. And you want to change it, you can just feel to change it. Okay, because it's not blocked, so you can just alter it, and you can enhance it yourself also. Okay, using these tools itself. Okay, after the course itself, there will be ongoing support. Will continue at 6 months, and I will regularly organize a graduate only seminar and webinar, maybe every quarter one time. Now COVID-19 got most people at home. I organize twice a month, every 2 months one time. But I may try to do it at least one quarter one time, just to update everyone on the market. Okay, what are the new watch lists we want to look at? What are the new changes in the market, so that you can go and prepare yourself. Okay, this course is not a theory class. It's more of a current market situation, how you apply it, and how can you invest better. Okay, through this course itself. Okay, the course fee itself, you get IBF approved in October last year. Okay, and it's 1284. And due to the COVID-19 itself, and government has started with a new rule from 8th of April onwards, means that 95% of the cost fee is pre-funded by government. What does that mean? Cost fee is 1284. You only pay 5%. 95% are going to pay for you. Okay, but of course there's a criteria. You must attend the course and submit the assignment. Okay, then you need to pay, and you are Singaporean, a skill future, you can use a skill future to pay. Practically it's something like a free cost to some of you. Next, I think we can't find this deal in the government. So far, I've been 14 years in the industry. I think this is the first time I see this. Okay, after attending, finish the course already, they pre-fund you the cost, and you only pay 5%. They pay you training allowance. Okay, this is from our finance minister. They pay you training, then pay you $10 per hour to thank you for upgrading yourself, and you get $160. Some people say they even profit from attending the course. Okay, so that is what this course is about. What is the frequently asked question? First thing, that is there a prerequisite to attend the course? Yes. Okay, this one I need to emphasize a lot of time. First thing, that you must know how to surf the net. Okay, it is no joke. Because we don't want it to be a computer class, teach you how to use the Google, how to log into Poems, how to go into SGX website, okay? And you must have a Microsoft Excel installed in your computer. You know, I can't open the file and do your work. Okay, so that's something to take note. Is it difficult to claim from IBF? This is IBF pay you upfront, so you are not claiming from them. They are paying you pre-fund for the cost for you already. Okay, will the price be the same in future? Definitely is no. Actually, we plan to increase the price, but due to the COVID-19, we have to stay put the price. Okay, after the COVID-19 over, of course, the price will definitely adjust up. Can you sign another date? Yes, you can, provided there is other date available. Currently, due to COVID-19, I have to conduct this course more regularly because I can't go overseas. Me and my wife, we actually plan to go over holiday 4 times a year. Okay, but COVID-19 this year we only went 1 time. We still got 3 times to go. So after COVID-19 over, I may have no time to conduct the course because I'm going to go holiday. So currently, these are the few days available. But if you cannot attend the day, don't let us know last minute. Just let us know in advance. We can always schedule in on the other day. Unless last minute, if for sake, of course, that one can't be held. We have to schedule other day. Do you need to bring a laptop? Yes, definitely need a laptop. You know, you can't do this course. Any subscription fee? No, you don't need to pay anything after the course. Okay, and that's one thing. You are worried after the course, you need all this data and you pay some subscription fee. There's no subscription fee. I share with you where to get all the free information. Okay, I myself also don't pay any subscription fee. So I'll share you how I get all this information and you don't need to pay. Is there any upselling for another course? Okay, I will not upsell any other course as I don't conduct other courses beside this. So there's nothing for me to, no other cost for me to sell you after the workshop. So no need to worry. Some people say this is practically a free course. So good. After 2 days, we need to pay a few thousand for another course. No, there's nothing to sell you. I promise you, I don't sell you another course after this. Okay, because I'm not conducting any others. Okay, what if you never sign up this workshop? Then I just need to thank you for this session. You still can contact us with our Jurong East client, and we're able to provide you advice. Okay, and if you are keen, you can just scan on this QR code. You lead to a website that give you more information, and you can sign up. Okay, just to take note, there's this 3 date, the 13th June and 20 June online class. Okay, based on my understanding from Cybercode, most likely they'll close the registration tomorrow. Okay, because it's going to full already. Okay, so if you want to attend the 13th and 20 June, you have to sign by tonight, this evening. But tomorrow, most likely they'll close it because the director just messaged me, say they want to close. I say, wait, after the webinar, then they close it. Okay, so then the rest, these are the rest of the date. For those that prefer to have classroom, okay, basically, then you need to wait until August. Okay, but August one, I also cannot guarantee you will be on a classroom basis because that have to depend on how is the circuit breaker, phase 1, phase 2, phase 3. Because phase 1, we are not allowed to conduct classroom. Okay, still not allowed to. So we don't know, or by August, it will already be phase 2 already now. Okay, so that's something to take note. Okay, meanwhile, for those interested, can I scan a QR code? Let me just answer some of the questions that you all have posed. Okay. Okay. So let me just go to the question, some of your posts. Okay. Must I attendance for this course? Yeah, attendance have to be taken because they are claiming from government. Okay. Do we have online lesson? That means you'll be a live online class. Okay, I'll be there to conduct live class and you can answer questions directly. Can use iPad? We actually don't recommend that because very hard for you to work on that. Okay, what is the summary? Okay, what is the summary of the takeaway course? Darren Ang, you can actually take the QR code, go inside. There's a page that actually give you all the course detail. I think the information should be good enough. If you don't feel that it's good enough, then you can look for us. Okay, this course mainly talk about how to build a multi-asset portfolio that give you passive income for life. Okay, despite a market up and down. So it encompasses on personal finance, encompasses on insurance planning, encompasses on retirement planning, and we look at stocks, REITs, bonds, and unit trust asset class. How to select them? Okay. There's online class and classroom class you can choose. Of course, meal is not provided. Is IBF already pre-fund 95%. You don't expect them to pay you meal, provide you meal also, right? Okay, and online class, definitely there's no meal. Okay. Yeah, currently it's online. After the circuit breaker over will be on classroom. So for those that attend the online class, after the circuit breaker over, allow big gathering, I'll hold the revision class on classroom basis. I think sometimes classroom basis can deliver certain thing that online class course may not able to deliver. So it will make, but some people prefer to continue online. It's up to you, because I will continue to do both along the way. Okay. If I ever attend the course funded by IBF, can you claim this course? Yes, as long as it's not the same course. Okay, you can attend all the IBF course as long as different course. Okay. Okay. How I register for course? That's a how's okay. Let me. Yes, the classroom they have changed from 25th July to August 15. The 15 one I think will be there. I think the 15 one was July one will still be there, because that one will close very full already. So we are not opening the 25th of July classroom to anyone, because those who sign up will be there. Okay. Okay. Online course will not be recorded. Okay. Okay. Irene, how you register? Just need to sign a code. Okay. Let me see that. How to pay upfront the 1K first, or pay the 64? You only need to pay the 64.20. Okay. You don't pay the 1284. The 95% government pay for you. But there's a prerequisite. You must you must complete the course. If not, the government will come and ask you to pay back the balance, because you signed up but didn't complete the course. Okay. So that is something to take note. Any age limit for the course? Yes. Anyone that's 18 years old and above can attend. 18 years old and above, because IBF fund for people that are 18 years old and above. Okay, so that's why we got class that father bring daughter to come, okay, or father bring son to attend the course itself. Okay, how do I call? As long as you are a Singaporean and PR, you are automatic qualified for the funding. Okay. Okay. Kim Law asks, can I have the course detail? You just need to scan a QR code. Okay. Okay. But last minute cannot make it. Okay. If it's due to sickness, of course we understand, but have to depend on what is your reason. Because if it's really a valid reason, we can actually schedule it, because we discourage last minute, as the course is very full. Okay. If you last minute cannot make it, actually you are depriving the chance of another person from one to sign up. Okay. So last minute activation of, okay. We actually lately just had one case. Okay, because he's on the IT side. Company got issue, you have to go in. That one we understand. Okay. And that one we can understand on that. Okay. Then for the case, we have to schedule him for the next round. Okay. And he don't mind wait for the next round because he need to work. Yes, you can arrange for subsequent joining. If it's a valid reason due to work commitment, last minute activation, you can't be held. Okay. Anyone got any other question? If not, I thank everyone. Okay, for those that want us to take a look on the portfolio and want to know about portfolio, you can contact us by our WhatsApp, or email to us, because you have been sent. There's a reminder sent to everyone. You just need to reply to that numbers. For those that didn't just fill up the feedback form. Okay. If not, I will thanks everyone for attending this session. Okay. Thank you, everyone. I'll be around. Okay. Any link I can't access a QR code. Okay, if you can't access a QR code, you can type this. Let me see. You can type a message to us/LIMCOURSE. Okay. wellhero.com.sg/LIM course. Okay, then you're able to get this. Okay. Now I thank everyone. Good night, everyone. Okay, Ben Sim asks, you don't look at dividend yield. No, we look at dividend yield for dividend fund. Okay, because that is one thing. But you have to look at realistic dividend yield. Okay, what is realistic? 4 to 5% is very realistic. Okay, because that's what you buy REITs, you buy stocks, you can get that 4 to 5%. Okay, I mean 9%, 10%. That one was not realistic in the aspect. So we're looking at realistic dividend yield. So you buy an Asian high yield bond fund, they can give you 7% dividend yield. Actually, that one is realistic because they're buying on a high yield aspect. But do take note, there's also a risk underlying. But anything higher than that is not so realistic. Okay. Okay. For rebalancing, is there a particular part of the year to do this? Okay, most people prefer to do end of the year. You see, maybe that time they are more relaxed in the aspect, and you see end of year market maybe you see more better. Okay, can it? Okay, okay. For those that can't scan it, you just need to go to wellhero.com.sg/LIM cost. Okay. Okay, I'm not good at Excel where I have problem catching up the cost. Okay, there will be some challenging, but the Excel we are talking about simple Excel. We are talking about plus minus times divide, insert row, delete row. We are not asking you to do macro programming. Okay, we are just asking you to do very basic Excel itself. Okay, maybe you just need to practice a bit before I attend the course. Okay. Okay, Chu, you asked me about the fund. I private message you. Okay. Okay, if not, I thank everyone and have a good evening. If you got any more questions, can just ask me, contact our team. Okay. Okay, bye-bye, good evening.